Everybody, good to see you back with us again this month for another WASD crop report. My name is Arlan Suderman, Chief Commodities Economist with StoneX, and I'm glad you're back here today. I was just wondering what kind of a crowd we would have, considering that it's active harvest pressure. So a lot of our people who normally on here are actively involved in one way or the other with the harvest, and it was a relatively uneventful report. So that gives us more time to spend on some of the other factors affecting the markets, both currently and longer term. And that's kind of the approach I'm going to take today. We'll go over the numbers, obviously, but there's a lot of other things to talk about. So that's what we're going to focus on and go forward. And of course, if you have any questions, be sure to put them in the Q&A box that's in the lower right hand of your screen. So let's get started. Price is a function of supply and demand as modified by the flow of money. The flow of money just simply modifies at what level the market manages supply and demand, and to some extent the timing, but supply and demand are still the critical components of the market. If we do want to talk about money flow, we have to start talking first of where we're at in monetary policy, in inflation. We see the latest numbers to come out on inflation yesterday. The consumer price index, the headline number down to 2.4%, getting ever so close to the Fed's mandated 2% level. However, core inflation that excludes food and energy sectors ticked higher for the second month in a row, is up to 3.3% right now. So that's a concern going forward. And as we look at what components are really driving that, you see on the left-hand side a breakdown of categories on the month-to-month basis, and you see that apparel costs, airfares were the big increases in inflation. Whereas on the bottom there, you see that fuel oil and motor fuel saw significant drops in September. So what would inflation have been if we didn't see that decrease in fuel prices? It would have been higher, the headline number, than what it ended up. On the right, you see the year-on-year changes. And so looking back over the past year, again, the decline in used car prices, motor fuel, and fuel oil are the big reasons why we've seen the headline CPI number come down. On the other hand, motor vehicle insurance is the biggest reason that we've gone up significantly. Now, there are other factors as well, but when you look at motor vehicle insurance, and a lot of this is actually due to a surge and just an explosion in car theft numbers, particularly in states that have relaxed some of their, bail programs and in the prosecution of people who steal cars. The insurance, we all pay for that in higher insurance rates, especially in those states. And that's been one of the bigger factors. But food has also been a major contributor, as well as shelter, as you can see there in these numbers. So let's move on. Why has the economy been so resilient, even as the Fed has been in a monetary tightening mode now for about the last, 15 months or so? And actually longer than that. It's really I guess it's longer than that. It's really been since March of 22, since they started withdrawing money from the stimulus from the economy, shrinking their balance sheet, and raising interest rates. But we've been seeing, initially, we saw the monetary base go down, but it's been trending higher over the last year or so. And I've been saying that a lot of that is because of the fiscal stimulus that we still see in the system. And ironically, one of the things that I've been watching for, and we now see happening, is we are seeing the credit markets starting to tighten. And the Fed has already reduced the rate at which it's shrinking the balance sheet once. And I believe that at the next meeting, they will reduce that rate again. And I believe at some point next year, they will have to quit shrinking the balance sheet, and we're moving back toward quantitative easing again. And one of the reasons for that is that because we are increasing the supply of debt certificates at such a rapid pace right now, that we don't have enough buyers, and we're going to be moving into that lacking of buyers, with foreign buyers taking their money home for reasons of better opportunities at home, and retail buying starting to slow. That you have an increased supply of debt certificates, a decreased demand, that decreases the value of the debt certificates, that increases the yields. And so I think particularly medium and longer term debt interest rates, that's one of the reasons we're seeing some of that upward pressure in like the 10-year treasuries. Now, as we look at the health of the economy, I'm going to say right up front, yes, there are segments of the economy that are struggling. Portions of the manufacturing sector are in recession still to this day. Housing sector has really been struggling. But with lower interest rates, we expect the housing sector to come back as consumer confidence comes back. That's one of the factors that's still waning. And as we saw in consumer sentiment today, much of that seems to be waning on the elections and what happens there. Now, the broader economy, second quarter GDP at 3%. We will soon get the numbers on the third quarter GDP. The models right now have it around 2.5%, so a little bit slower, but still relatively solid GDP growth. If we look at the unemployment rate, back in August, rose to 4.3%. Now, those of you who have some gray hair on top like I do, remember that 4.3% is historically still a low number for unemployment. We feel for that 4.3% that's unemployed, but from a big picture economic standpoint, that's historically a low number. But yet at Jackson Hole, Wyoming, at the end of August, Jerome Powell, chairman of the Federal Reserve, said, we can't let it go higher. He lowered the ceiling and said, if it goes higher, we're going to have to increase our speed at which we cut interest rates. But since then, what has it done? It's gone down in 4.2% with the jobs report we got in early September, 4.1% with the jobs report that we got 1st of October. And not only that, the number of jobs created in September were nearly twice what was anticipated. Now, government jobs are a big part of that. I want to be upfront with that. But we are seeing some expansion in private sector jobs, especially at the lower income level, leisure and hospitality. That was the last sector to really catch up after the pandemic. But we're seeing some improvement, but a lot in the surveys, industry surveys, particularly some of the PMI, Purchasing Managers Index surveys, et cetera. And we're seeing industry saying they're waiting until the election to really decide what they're going to do on employment. A lot of tax, potential implications of tax policy going forward that could impact hiring practices going forward. Remember the big tax structure change that we had during the Trump administration is scheduled to expire next year. And that will have major implications on the firms that do the hiring. If it's allowed to expire, their taxes will go up significantly. Some of their abilities to write off expenses will go up, and that will decrease their willingness to hire. And so that is what they're waiting to see based on the campaign promises made by the two candidates. And right now, it's pretty close and tight in the election. So if we look at tying this to commodities again, as I showed you last month, when we got had the big yen carry trade unwind there at the 1st of August, we broke the 5-year break-even inflation rate down below that support level at about 2.1%. But we have climbed back above it. And look how commodity prices have responded as well. Now, which came first, the chicken or the egg? And it typically goes inflation expectations lead money flow into commodity prices. This time it was almost simultaneously, and especially after the 50 basis point rate cut on September 18th, we saw inflation expectations go up. Now, this is still not enough to confirm